Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Opendoor stock skyrocketing, new and existing home sales, and mortgage spreads. Logan, welcome back to the podcast.
It is wonderful to be here on Monday morning and so many headlines right off the bat. And this is why we're here 4 times a week.
So
Eventually,
true.
One day you'll give in and make me happy 5 days a week. But
listen,
step.
the first thing I want to ask you about is this Opendoor stock. This thing is going crazy. What does this mean for the rest of the housing market? Like, how are you interpreting this?
Okay. This has nothing to do with the housing market whatsoever. This is when Opendoor stock was really, really low. Some Wall Street firm bought in a big position, and another Wall Street talking head talked about it. Then Reddit got involved into it, and you know how these things work, and it's gone parabolic. And it's not just that stock. There's a few other ones that have kind of really picked up steam recently, but this one has literally gone vertical. Just kind of think of it as money kind of piling in, and what we call is exit liquidity for people that got in early, because those buyers can make it easier for them to unload their position. Don't think anything about the housing market. Now, the builder stocks, right? There's all these negative headlines, housing construction permits are down, starts aren't going anywhere, builders' profit margins are falling. The builder stocks now have performed a little bit better since May. And that to me is just the 10-year yield was heading lower. Mortgage rates are not that far from their year-to-date lows. Mortgage spreads are also getting better. We talked about that in the tracker. And if the 10-year yield, mortgage rate spreads, everything can facilitate near 6% mortgage rates, what it has done over the last few years is that builders' confidence for smaller builders, not the big publicly traded builders, gets better. Traffic gets better. Permits tend to grow. So traders try to get ahead of that, and they realize that if rates are falling, 10-year yields falling, you want to get ahead of that move when that occurs, when it finally hits the data. So the builders with the 10-year yield has a little bit more validity. You want to just kind of ignore that story.
Okay, well, one of those negative headlines about builders was your own, when you wrote a couple of weeks ago that new construction was basically dead because of mortgage rates or where the 10-year yield is. So no matter what their stock's doing, has your assessment on that changed?
Absolutely not. Until you see single family permits and confidence rising, it hasn't worked. Now, I think what happened last year toward the end of the year is that the builders' confidence data was picking up, and a lot of people went with that. Our take was that the supply and demand equilibrium for the home builders are going to be challenged in 2025, because when rates get towards 7%, or even higher, they don't really perform well, especially the smaller builders. So I think the smaller builders went into it thinking deregulations, lower rates, we're good to go. And it has completely reversed, right? So now, if you told me mortgage rates are heading towards 6% and going to stay there for a while, builders' confidence picks up. The builder stocks do better, like they kind of have already to a degree. And then single family permits can grow. But going back since late 22, we always talk about how structurally the housing dynamics shifted on November 9th, 2022. If you look at the builder stocks, that was kind of like the bottom before their big run, because so much was priced in on the negative side. Nobody had that. Well, the builders can grow sales and pay down rates, and things will be okay. So there's always this fine equilibrium between equities and the realities of what's happening on. But in this case, housing permits are early COVID-19 recession levels. Housing starts at early COVID-19 recession levels. Builders' confidence is not that far from the lows levels in COVID-19. Traffic, prospect, everything is down, down, down. And that makes sense. But if you just get towards 6% and stay there, it makes it easier. Why? Because when it comes down to it, it's all about, can you sell that home and make money? Right. And I think the builders' confidence rising into the start of the year was a head fake, and it quickly reversed. Right. Tariff talks, higher rates, stuff like that. But if mortgage spreads getting better, improvement, good. 10-year yield to go a little bit lower. You don't necessarily need sub 4% 10-year yield anymore to get mortgage rates near 6%, where in the previous few years, that would be the case. But the fact that the spreads are getting multi-year lows, it's a positive story. And investors and traders are mindful of that more than I would say the general public or even anyone in the housing industry. As you and I have seen going out on the nerd tour for the last few years, mortgage spreads is not something people know or talk about or understand. So we're trying our best to kind of explain it. And this last weekend's tracker kind of went into that.
Well, that was going to be my next question is let's talk about mortgage spreads because they are making a difference. Can you give us the historical, like here's where they usually are, here's where they are now, and where you think they're going to go?
Mortgage spreads. Okay, so going back to the 1970s, if you take our data, remember mortgage spreads can be different from anybody who quotes mortgage rates. So we're just taking the Fred data and the Freddie Mac mortgage rate data. 1.6 to 1.8%. That's the spreads between the 10-year yield and 30-year mortgage rates. And why do we focus on the 10-year yield and 30-year mortgage rates, Sarah
because
Wheeler?
Of the slow dance between these two.
Slow dance. Oh my God, just a passionate, lovely. We love intense, passionate, close to slow dancing. So when the spreads are normal, that's where it gets. Now, throughout history, whenever rates rise, market stress, spreads get wide. That's what we talk about. The guy messed up. He looked at another lady at the club. The girl's not into it, and they're dancing far apart. Not a good thing, right? You're not going to get the job done after the party of that. But throughout history, right, when the Fed starts cutting rates and volatility compresses, and time goes on, the spreads get better. Now, I think a lot of people just said, in 2024, there was only a few of us in America that talked about the spreads improving in 2024 because people thought, well, the recession is going to come and spreads go vertical in a recession. That's not necessarily true. This is why we like to do the spreads in the history. We teach people how this works. But what's going on with the spreads looks very normal to me. And it can get a lot better, but we're almost like we're past the halfway point of the spreads getting back to normal. So if mortgage rates were priced on the 2023 spreads, which were really bad, you're 81 basis points higher today.
Ooh.
But if mortgage spreads just get back to normal, I'm doing an average between 160 and 180. You're 6.25 with the 10-year yield at 4.42. 10-year yield down this morning, 5-6 basis points. 200-day moving average is being tested here. And then you're looking at lower mortgage rates. So naturally, the spreads improving is a huge deal to an industry that doesn't know much about it. But that's our job. The nerd tour, the chart daddy, the brain candy. My job is to explain the spreads and the slow dance and the 10-year yield and mortgage rates and say it in a way that people can understand.
So as you mentioned, like it's sort of right now because the spreads are getting better. It's sort of a buffer. Otherwise, we would be like high 7s, maybe even 8.
No. We would be closer to 8% today if we had the 2023 spread. Even if I took the spreads from last year, we would be higher. A really good example last year when the 10-year yield was rising up, we had 7.5% mortgage rates. We're not getting 7.5% mortgage rates, even if the 10-year yield got to those levels because the spreads are better. So now when Godzilla tariffs happened, market stress, spreads got worse, but only by 20 to 25 basis points. So it's doing what it normally does, right? And it's just that there is more upside for rates to go lower if the 10-year yield and spreads both improve. But we are finally in a spot where you don't need the 10-year yield to get below 4% to get near 6% rates, right? We're not there anymore. And if the spreads just improve, 30 to 40 basis points, we're almost back to the normal level. And that was it. That was this cycle's version of mortgage spreads accelerating higher and working itself back down to normal.
So, when it comes to the 10-year yield, you've given people a range. People are looking at inflation to know what the Fed funds rate might go. How do you know how to predict where, or how does our audience know how to predict where the mortgage spreads are going to go? Like, what makes
just come
them
to the
better?
Chart Daddy every weekend. There's nothing else. Just come to the Chart Daddy or go to Instagram stories. We try to explain the spreads on Instagram stories. We keep everyone updated on what's going on, but we also explain why. As volatility compresses and the Fed, for example, if let's just say that there's trade deals done and
Let's
the
just
tariff
say that.
percentages is
Okay.
really down. And then the Fed goes, okay, we're back to our 2 rate cuts, and then they talk about, oh, the labor market isn't as strong as we think, so we need more rate cuts. Whatever it is, the spreads can get lower in that environment. But you're working from an elevated level where in the past, sometimes you get market stress and the spreads go vertical in a recession. We saw that in 2008. We saw that in COVID. Here is a different case. The spreads got really bad in 2022, and then 2023 got the worst, and then they've been working themselves down. So again, tracker, everything. You got everything there that you need for housing on a national story. But again, it's a little bit ahead of everyone else. So we keep everybody fresh and updated. And the mortgage spreads is a big deal because I love the slow dance between a 10-year yield and 30-year mortgage rates, and the spread is the second variable in that.
Okay, well, let's talk about that Fed, right? Let's talk about the latest on Powell, because we've talked all the other variables about mortgage rates and where they might go. Where are we on Powell?
It looks like one of the Republicans brought up maybe possible criminal charges of perjury against Jerome Powell. We are at that stage right now. Of course, this is why I did that video of, Squid Game, where the doll chases Jerome Powell. Here we are again today. And I tell people this is kind of like the first step. If it goes to that next level, which I don't believe it should, and there are stories that Besant talked to Trump privately and said, hey, listen, don't do this. This is just going to be a lot more market stress and the legal cases, but it's not going to stop with him. They're going to go after regional Fed presidents. There's some regional Fed presidents that you could pull out some skeletons too. So this is why this becomes just a hot mess, because it can't just stop with Powell. And again, if it is true, if we do get a shadow Fed president, at least that can take the firing and resigning of Powell out of the equation. I know one of my Wall Street friends had an interview talking about Jerome Powell should resign for the Fed, the sanctity of the Fed. No, you do not give that monster a cookie, because it's going to ask for a glass of milk, then a milkshake, and then a cake, and then ice cream. And it's not healthy, right? You cannot get into that area where you submit like that. We had rules on this to keep it separate, so we don't have bully ball, New York bully ball. You know how we deal with bully ball? These men on Twitter who run around and we challenge them to live debates. We say, homie, let's go. I want your family, your kids, and I want all of you. I want everyone in America to see your forecasts and your models, and let's do it live so I can get it recorded. Powell should say, hey, Trump, let's have a live national debate.
Oh my God.
Why do you want emergency rate cuts? Like, why do you think the economy is that bad that you need the Fed funds rate so low that it's something that happens? Is there something that you're not letting us know with a trade war that you think you need? I'll just go right at him. Of course, that's never going to happen, but that would be my tactic.
That would
throw it back at people, force them to get in the open, and that kind of things. 99.9% of people walk away, but in this sense, you put him at bay. The problem is Powell doesn't do that. Powell can't really do that. And he just gets bombarded day in and day out, and now it's perjury, and now it's this. And when that happens, hypothetical, let's say Powell has to be fired, then the regional Fed presidents is like, this is why this doesn't work. We don't do that here, So that's the latest Monday morning on this.
So I just want to clarify, because you said the regional Fed presidents might have skeletons in their closet, but I don't think you're trying to say there that you think they've done things wrong, just that there might be things that Trump takes exception to.
They will find anything. Okay. If you did not pay a parking ticket in 1978 or you did not return a library book in 1985, they will find it, right? And they'll just throw it at it, left and right. This is New York bully ball. This is what he does, right? And Jerome Powell has to just sit there and not say anything, and So this is why this avenue. I'm hopefully, if the story is true that Bessent kind of took Trump in and said, hey, listen, this is not going to really work like you want. And we've talked about that. Like, if Trump's not going to get what he wants by firing Powell, you have to go after all the presidents, and that's stuff Turkey does, right? This is America. But I think the bigger question is, why do you need emergency rate cuts? Like, for us, we're just talking about just kind of guide down to neutral policy. If the labor market breaks, it doesn't matter. The 10-year yield will go ahead of that. But this is emergency rate cuts, so but Powell can't do anything. The regional Fed presidents can't really do anything. So it's just they're all punching bags at this point.
That is crazy. Okay, what are we getting this week as far as housing data?
Well, existing home sales and new home sales. And again, existing home sales, nothing much is happening. You could have a month-to-month decline. I don't think anybody has any a big forecast there. But if we do show year-over-year growth, which that's even a question, the bar is so low. I mean, I cannot express to you how low existing home sales are going to be. This is the July report for June. June all the way to October is going to be literally, to me, the lowest bar. You take COVID out of the equation. Of course, you take the bottom of 2008 and the tax credit in 2010 out of the equation. This is the lowest bar of comps in the history of America, man. It is the third calendar year of the lowest home sales ever recorded in history. So this is, again, one of my contentions that I'm worried about is that the people of this country might turn on the Federal Reserve. Imagine if Trump actually could get mortgage rates down to like 5.5 and 5.75 and people start buying it. Do you think people would actually care, that, the regional Fed presidents are booted out? So when you have the third calendar year of the lowest home sales, and I am not just saying that out of hyperbole, when you adjust it to the workforce, this is what it is. People get frustrated, right? And Trump's doing the attacks on Powell in not the most effective way, but you can, in a sense, you could rally a country against the Federal Reserve. And that's, Bassett actually talked about that this morning, that the entire Federal Reserve needs to be looked at in a different way. So there's a lot of drama there, but existing home sales, don't expect much. I love 2025 for the reason that inventory is growing and it becomes a more a buyer's market, and the supply and demand equilibrium can function normally. It could not function after 2020. This is why the whole team higher rates, we need higher rates in 2022. We need even higher rates in the mid part of 2022. Do you remember that quote I gave, to the news outlets in 2022? We had already had mortgage rates go from 3 to 5%, and then from 5 to like 6, and we were heading back down. I was like, this is not going to work, right? We need higher, after rates rose 3%. I was like, we need higher rates to put home builders, home sellers, and investors on their ass. And the reason I use that language is that they had too much power, and everyone was happy when, oh my God, multiple bids, high five, home sales are up, home prices. Nobody cares about the sustainability because everyone was making money. And the only mechanism we had was higher rates. And imagine if rates never got above 5%. It wouldn't work. If rates never got above 6%, we wouldn't get inventory back to these levels. But now I'm happy. I love it. I love the 2025 housing market, just for that, because you have to think about housing in the long run, right? And shortage inflation is the worst because it's really like, it's just not having enough product. The housing bubble was a massive credit boom. Their sales were booming, but inventory was much higher during the housing bubble years. I did this presentation one where I showed people active inventory is like 1.5 million higher back then. They're like, what? I said, yeah, inventory was growing, sales were growing, that was a credit boom. Here, it's just a raw shortage of housing. Like, we had only 240,000 homes available for sale in March of 2022. That was savagely unhealthy, and now not the case. So every year that goes by, affordability is on a better track than what it was before. This is why we were team higher rates, which is not popular, and y'all threw tomatoes at me, and I dodged every single one of them because I'm Neo from the Matrix. But in this case, good. I mean, so we're going to get the existing home sales report. I mean, the question is, do you even get year-over-year growth or not? But again, very low bar, not much is happening. Same story as always. Purchase application data, you asked me about, all this year-over-year growth, but think about it in this light, very simple terms. If new listings data is growing year-over-year, and we never got back to the normal trends pre-COVID, but if it's up that seller is a buyer. That seller is sitting there waiting for a buyer to buy that house. Then that purchase application data could go into the sale. So this is why we say 30 to 90 days, but that seller needs a buyer to be that next buyer. And that's how the ecosystem's worked with housing. So I know a lot of people are confused about the purchase application. We're trying our best to explain it, but this is a very, very unique year where you had record low levels and new listings data grew, and mortgage rates actually have been down for most of the year on a year-over-year basis. So kind of a once an anomaly backdrop.
I do think that new listings part is so important. And one of the things you also cover in the tracker. So again, I would just recommend that to our entire audience. And Logan?
Yes. And the new listings data, I love that the fact we got to 80,000. I didn't get that last year. That was one of the calls I got wrong last year, and my home price forecast was too low. But this year we got up to 80, but we never got the, at least
that's
a few
weekly.
weeks between 80 to 100,000 on a week-to-week basis. 2013 to 2019, between 80 to 100,000 would be normal new listings during the seasonal peak period. But no, it looks like maybe 83,000 might be the peak of the year, but we never got that. And we're now in the seasonal downturn of new listings data. And just remember, during the housing crash years, this was running at 250 to 400,000 per week for years, Sellers that were not going to be buyers, right? That were distressed sellers, a lot of them, underwater marketplace, whole different story back then. Not the case now. We are in almost August 2025. We ran the gambit. We had the 3 years of the record low levels of sales, and it looks a lot different than, 2005 to 2008 for obvious reasons. Different credit market back then. We had some crazy crypto Twitter account that said, it's a line the anti-central bank people use. Unless you're a millionaire, don't ever buy a house until you get a 2008 housing crash. You guys understand this. And we go, imagine yourself as a man telling this is why I never have to worry about the ladies on this. Single women, they buy homes more than single men. But imagine telling you, I listened to some fake account. He said I shouldn't buy a house until 2008. And if that lady stays with you, I'm telling you, man, she is in love, because people would be like, no, you just can't pull the trigger. You're just not that guy, right? So most people don't operate that way. Millions and millions of people buy homes every single year. We're going to have near 5 million total home sales this year, as we did the last few years. But it is still, when I look at the existing home sales market, it's the lowest levels ever. When I look at the builders, new home sales, still at 2019 levels. Why? Sub 6% mortgage rate in that marketplace. Not been the case here for a long time.
Amazing breakdown. You did it in 22 minutes. We are doing so good these days, keeping it to about 20 minutes so people can get their information and get on. But so appreciate you, Logan, and I will talk to you again very soon.
Pleasure, Wheeler.